By 2026, Amazon is deploying approximately $200 billion into physical capital expenditures. This is a deployment of industrial infrastructure so massive, it shifts the global geography of compute capacity and electrical grid load. Yet there is a strange discrepancy in how the market is reacting. CEO Andy Jassy just released what is objectively the most data-rich, bullish shareholder communication in Amazon's history, and the stock is trading with notable weakness. The mechanism driving this weakness is a single capital allocation decision. Amazon chose to increase its capital expenditures by $50.7 billion year over year heading into 2026. That single decision triggered a violent compression of free cash flow. In 1 year, Amazon's free cash flow dropped sharply from $38 billion down to $11 billion. Wall Street algorithms and short-term analysts typically read a sharp drop in free cash flow as a severe risk. They look at the $200 billion aggregate spend and interpret it as capital being incinerated in a speculative AI bubble. But the data in Jassy's letter contradicts that fear. Amazon is not building on a hunch. This accumulation phase is directly backed by signed enterprise customer commitments and a contracted backlog. Because the broader market misinterprets this specific cash flow trough as deterioration rather than investment, it creates a structural pricing inefficiency for institutional buyers willing to look past the next quarter. To understand why this cash flow compression mechanically guarantees future revenue, you have to look at the cash cycle of hyperscale cloud economics. There is an unavoidable time lag between when cash goes out the door and when it starts coming back. This chart maps the timeline of deployment. Capital is spent at month 0 on land, power distribution, and silicon. But before a single customer is billed, there is a 6 to 24-month gap where that capital sits in a physical dead zone, unmonetized. Once those data centers and servers come online, the dynamic flips entirely. The heavy upfront costs convert into steady, high-margin revenue over the 5 to 6 year lifespan of the chips and the 30-plus year lifespan of the physical data centers. Amazon ran this exact financial playbook during the original Web 2.0 cloud expansion. They sacrificed early cash flow to build capacity ahead of the market, systematically locking in structural margins and dominant market share later. The 2026 AI infrastructure build-out carries even lower risk. Unlike speculative capacity additions, much of this upcoming capital expenditure is already spoken for by signed multi-year enterprise contracts. The backlog is so deep that customers are currently reserving capacity on Amazon's Trainium 4 chips, a generation of custom silicon that is still 18 months away from even being broadly available. When $200 billion is deployed directly against a contracted backlog, the short-term drop in free cash flow represents the literal cost of locking in multi-year recurring revenue. The enterprise demand for AI compute is currently hitting against structural constraints, and the resulting momentum is massive. The primary data point validating Amazon's capital expenditure is the growth velocity of its AI layer. By the first quarter of 2026, AWS AI reached a $15 billion revenue run rate. This chart plots AWS's initial commercial launch against its current AI launch. 3 years into its existence, the original AWS had a $58 million run rate. At the exact same 36-month mark, AWS AI is 260 times larger, ascending on a near vertical curve. This trajectory is happening while the broader market is severely bottlenecked. Amazon is actually leaving unserved demand on the table due to capacity limits. The ceiling on this growth is not a lack of enterprise software use cases. The hard limits are entirely physical: the manufacturing yield of custom silicon and the procurement of gigawatts of power. In a severely supply-constrained market with a massive backlog, every new unit of capacity that comes online is instantly monetized. Opening up the supply valve triggers compounding revenue upside. Moving down the physical supply chain reveals the true scale of the inference economy. This is the stage of AI where models are trained and then run continuously, 24/7, to process live enterprise queries. Processing these continuous inference workloads requires endless rows of dense, high-performance server racks. To manage the economics of inference at scale, Amazon is deploying its own custom Trainium silicon. By designing their own chips, they expect to cut tens of billions in capital expenditures per year and capture several hundred basis points in operating margin advantage. Amazon only monetizes these chips through its own cloud compute instances. If its custom silicon unit operated as a standalone company selling to third parties, it would already be generating a $50 billion annual run rate. This proprietary silicon strategy does not eliminate NVIDIA from the equation. The total addressable market for AI compute is expanding so rapidly that it easily absorbs both hyperscaler design chips and third-party GPUs. NVIDIA maintains its baseline dominance. AWS will continue to partner closely to ensure their cloud is the best place to run NVIDIA hardware. Below the cloud providers, companies like Broadcom act as credible toll booths, providing the custom networking and ASIC design necessary for Amazon, Google, and Meta to build their proprietary silicon. But the ultimate physical constraint capping this entire AI supercycle is the availability of high-voltage electrical grid power. AWS added 3.9 gigawatts of new power capacity in 2025 alone. To meet their contracted backlog, they have committed to doubling their total global power capacity by the end of 2027. This aggressive power procurement sets a structural floor for secondary equities. Data center thermal management companies like Vertiv and Eaton, and merchant power generators like Constellation and Vistra are direct beneficiaries. Amazon's $200 billion capital expenditure acts as a gravitational center. It guarantees multi-year revenue floors across the entire power and silicon supply chain. Beyond the AI infrastructure build-out, Amazon's core non-AI businesses are currently firing on all cylinders, proving the company's operational execution is broad. In grocery, they solved the cold chain logistics barrier. By integrating perishables into their same-day delivery network, fresh food sales grew 40 times over since early 2025. This drove their grocery unit to a $150 billion gross sales run rate, making Amazon the second-largest grocer in the United States. This operation relies on an enormous physical footprint, heavily supported by the deployment of over 85 dedicated same-day fulfillment centers carrying tens of thousands of items. The sheer industrial real estate required to execute millions of same-day deliveries creates sustained global demand for last-mile infrastructure. Then there is Amazon Leo, their satellite broadband platform. Scheduled for commercial launch in mid-2026, it is already securing massive enterprise anchor tenants, including Delta Airlines, which selected Leo to power Wi-Fi on 500 planes. On the consumer front, the rollout of Alexa Plus successfully converted 600 million passive endpoints into active AI agents. Users are now completing purchases on these devices 3 times more often than before. While the AWS AI infrastructure provides the massive upside for the stock multiple, this operational dominance across grocery, satellite, and consumer logistics provides a reinforced floor for the company's valuation, which brings the analysis back to the Wall Street paradox. The market is pricing a $50 billion jump in capital expenditure as a severe operational risk. This chart shows the cash cycle. The free cash flow line dips deeply into a trough during the 2025 and 2026 deployment phase. As data centers come online and contracts convert, the line aggressively curves upward into massive, high-margin recurring revenue for 2027 and 2028. The current stock weakness is simply a mispricing of duration. This creates a rare accumulation window for long-term capital before the hyperscaler monetization lag clears. The baseline metrics are clear. AWS is at a $142 billion total run rate. The AI layer is accelerating past $15 billion, and custom silicon is delivering the margin equivalent of a $50 billion standalone chip business. In the history of public markets, betting against a monopoly cloud provider that is deploying $200 billion into a supply-constrained market with signed receipts already in hand is a losing proposition.